If the stock and bond only buy and hold strategy touted by almost every financial professional out there turns out to be wrong, you will be left holding the bag, not them. It's so important you understand the flaws with the traditional way of thinking about investing. That's why, even though I feel pretty confident these videos won't perform particularly well with the YouTube algorithm, I'm still dedicating the time to create them for you, to help you better understand my concerns here and ultimately help you become more confident in your long-term investment strategy. Let's go. Welcome back to the most dedicated of my subscribers. You all are wonderful, and I sincerely hope these videos are starting you on a path to true financial confidence and long-term success. Now, in our last video, we went through several historical examples where a person living during that time would have had way more data than we do today about the stock market to point to regarding a trend and their future. Yet, those trends all changed. History was made, so to speak. You can't use what's happened in the past, really no matter how much data you have, to prove something, some theory, forever into the future. In the 6th century BC, Croesus, the king of Lydia, was thought to be the richest man in the world. According to Greek legend, a renowned wise man by the name of Solon visited the Lydian king. And Croesus sought acknowledgement of his own grandeur by asking Solon to identify the happiest man he had ever met. Solon told Croesus of a peasant he had met in Athens who worked hard, raised his family, was content with all he had, and died happy. This was not the answer for which Croesus was fishing. He continued to press. After enough unsatisfactory responses, he finally just asked Solon directly if he were not the happiest person that Solon had ever met. In Nassim Taleb's retelling of the legend, Solon responds, "The observations of the numerous misfortunes that attend all conditions forbids us to grow insolent upon our present enjoyments, or to admire a man's happiness that may yet, in the course of time, suffer change. For the uncertain future has yet to come with all variety of future, and him only to whom the divinity has guaranteed continued happiness until the end may we call happy." After which Taleb simplifies Solon's message. The modern equivalent has been no less eloquently voiced by the baseball coach Yogi Berra, who seems to have translated Solon's outburst from the pure Attic Greek into no less pure Brooklyn English, with "it ain't over till it's over," or in a less dignified manner with "it ain't over till the fat lady sings." Up until that point in time, Croesus's life, if plotted on the statistician's trusty XY graph, wealth, good fortune, happiness on the y-axis, over time on the x-axis, would have revealed that familiar by now uptrend. Solon, in his wisdom, knew those past data points did not guarantee Croesus's future. Sure enough, shortly after this encounter, the king's luck began to change. His son was killed in a hunting accident, and his empire was conquered by Cyrus the Great of Persia. Through his management and growth of Berkshire Hathaway, Warren Buffett has become the epitome of a savvy investor. $10,000 invested with the Oracle of Omaha in 1965 would have grown to more than $274 million by the end of 2019. Compare that to the $1.9 million you would have realized from the same investment in the S&P 500 over that same period of time. In his 2018 letter to shareholders, Buffett offered a Solon's warning of sorts for investors in Berkshire's insurance subsidiaries. A major catastrophe that will dwarf Hurricanes Katrina and Michael will occur, perhaps tomorrow, perhaps many decades from now. The big one may come from a traditional source, such as a hurricane or earthquake, or it may be a total surprise involving, say, a cyber attack, having disastrous consequences beyond anything insurers now contemplate. When such a mega catastrophe strikes, we will get our share of the losses, and they will be big, very big. Buffett is acknowledging the reality that some catastrophe that has never before been experienced, whether it's tomorrow or decades from now, will happen. To that end, Buffett is cautious, holding a large cash reserve, and always attempting to not be overexposed to any one surprise event. We use debt sparingly. Many managers, it should be noted, will disagree with this policy, arguing that sufficient debt juices the returns for equity owners, And these more venturesome CEOs will be right most of the time. At rare and unpredictable intervals, however, credit vanishes and debt becomes financially fatal. A Russian roulette equation, usually win, occasionally die, may make financial sense for someone who gets a piece of the company's upside but does not share in its downside. But that strategy would be madness for Berkshire. Rational people don't risk what they have and need for what they don't have and don't need. For those of you not familiar with Russian roulette, it's the game where you have a 6-shooter pistol, but only one bullet in the chamber. You spin the chamber, hold it to your head, and pull the trigger. There are 5 chances that nothing will happen, and 1 that you end up dead. In his illuminating book, Fooled by Randomness, Nassim Taleb references a similar sentiment as Buffett does here. Taleb adds money to the equation. If a deep-pocketed and perverse thrill seeker offered you $1 million if you survived after playing 1 round, should you do it? A strict analysis of the potential possibilities reveals that, from a financial perspective at least, mathematically, playing is clearly in your favor. There's an 83% chance that you walk away with $1 million free and clear. Of course, however, in that 1 out of 6 chance that you happen to find the bullet in the barrel, well, you're dead. As Buffett said, a Russian roulette equation, usually win, occasionally die, would be madness. Rational people don't risk what they have and need for what they don't have and don't need. With Russian roulette, you're aware of the odds. They're 5 to 1. Taleb points out, however, that in the world of investments, the odds aren't known. Yet most professionals and academics proceed as if we do know them. As consumers, we buy into their narrative, perhaps because we want it to be easy. We want it to all make sense. But in reality, if we're talking about that mega catastrophe, the likes of which have never been seen, the big one, as Buffett called it, the odds of that happening versus a normal day in the market where the action is within a range that you'd expect are 1 to thousands or tens of thousands. So as those catastrophic events don't happen, because they don't very often, people start to think that they won't, that they can't. One of my pet peeves is the way that financial advisors and pundits and even financial YouTubers behave when the market starts to crash. During chaotic markets, these experts flood social media with general statistics, charts, and graphs of market recoveries from the past. They say, you don't need to worry. The one thing all these crashes have in common is that the market has always recovered. Have you seen those? Have you heard that? Every time I see or hear this, I can't help but imagine that advisor sitting out on his front porch, relaxing with his wife, watching their kids run around their front yard. All of a sudden, 2 of their children run across the busy street in front of their house without paying much attention, narrowly avoiding being hit by the zooming traffic. His wife yells, standing from her chair, ready to nip this dangerous behavior in the bud when the advisor calmly grabs her arm and says, "Don't worry, honey, they'll be fine. I've seen them run across that busy street dozens of times, and nothing bad has ever happened." A worse scenario than has happened in the past is always a possibility, and it's dangerous to ignore that. Millions of hardworking couples who had already retired around the year 2000 and again in 2008, who had been following that mainstream advice, were rudely met with this reality and forced back to work just to get by. And that's not even to say that something worse couldn't happen in the future. Being better prepared starts with understanding and fully accepting this reality. And then from that solid foundation, you can build a much more confident financial future. So for now, we're going to keep exploring this buy and hold myth because it's one of the most egregious myths just blindly adhered to even by almost every financial advisor out there. I'm the weird one here. Let me know in the comments though if some of this is starting to click. I certainly hope it is. Here's the next video in the series, and here's the full playlist where I take you through my favorite part of Myth 10 from my Stop Investing Like They Tell You book. I can't wait to see you there. I wish you all the best. Take care.